Great. I want to thank everyone for joining us today. For those of you that are new to our quarterly economic webinars, I'm Lindsey McKay. I'm the lead advisor at McKay Wealth Management, and every quarter we invite a different partner to join us to share thoughts on what's going on with the markets. So I'm pleased to introduce or reintroduce, if you've participated before, Justin from J.P. Morgan Asset Management, who's um, joined us regularly to share J.P. Morgan's thoughts. So Justin's going to take over here in a moment. We'll once again just remind you if you have a question or something that you would like to ask, please share it in the question and answer bar in the bottom of your screen, and we will make sure to address it either live during the webinar or if appropriate follow up after the meeting's over. So with that, I'll turn it over to you, Justin.
Thanks, Lindsay. Good afternoon, everybody, and thank you for joining us here. And hope the summer is going well. We just I know it's already a few weeks into July, but we just had the best quarter since 2020 for the S&P 500 or the broader U.S. equity market. We're going to unpack a little bit today of really why that is, and in fact, we're going to use our guide to the markets, which we've done in the past, to sort of unpack the why behind it, some of the opportunities that we certainly have when it comes to this investing environment. Also, a couple of the risks that we see also, and really, again, the reasons why we diversify and have a lot of different things working for us in our portfolios, because it's not always as rosy as it may appear. But as I mentioned, we have had a very, very strong year, all things considered, so far for the U.S. Market, and we're going to sort of just unpack that here in just a moment as we sort of just go through what we think for the second quarter and throughout the year so far. I always like to start on this page of our Guide to the Markets. It is a page which we've used now for years, but it just gives us some degree of semblance as to the volatility that we experience. Now, I had just made mention of the fact that this market is doing quite well. And in fact, if you look all the way off to the far right, the U.S. equity market is up 9% this year. That's the S&P 500. So all of these gray bars that you see here reflect what the market has done in each of the last about 45, 46 years. The red dot that you see is the biggest pullback or correction that the market experienced, the biggest downward sort of trend that the market had in that given year. Maybe not surprisingly, we tend to sort of look at the market and saying, well, it's, as I mentioned, it's not always rosy. It can sometimes feel painful. Every year, going back 46 years, going back 100 years, if this extended back that far, you see the market, it has a red dot. So it's never perfect. It's never just a linear line upward. And in fact, if you see all the way off to the far right here, this market back in March did have a downturn of 9%. And in fact, one sort of core theme that we'll talk through today is just how resilient the U.S. equity market has been. Because if we think through it, just in the last, call it 18 months, not even 18 months, 15 months, 16 months, we've had tariffs impacting the U.S. equity market. You've had government shutdowns. You've had wars and certainly geopolitical risk ongoing. And yet, as it stands, 2025 finished up positive 16%, even though intra-year we had a 19% pullback. And so far this year, despite a 9% pullback back in March, the U.S. equity market is up 9% as we sit here today. And so it's an important reminder that there'll be a lot of headlines, there'll be a lot of noise, there'll be a lot that maybe at times deters us as investors from making rational investment decisions. But despite on average an intra-year pullback of 14%, which you can see up in this top left, if we were to average out all these red dots over the last 46 years, the average pullback is 14%. Despite that, the U.S. equity market has finished positive 35%. out of the last 46 years. So there's a lot on the minds of investors that could say, hey, look, I don't know if I fully grasp why the market is going up or why it's doing what it's doing. But it's an important reminder to stay invested, obviously get invested, but stay invested because this market is very oftentimes more resilient than we give it credit for. Now, if we were to unpack a little bit of why the market has been as resilient as it has been. Remember, we've had a lot thrown at this market, and I mentioned some of the events in the last 12 or 15 months that in theory you'd say, boy, that should cause more angst to this market, or we should be seeing more of a downward trend than in reality we actually have. And underneath the surface of all of that, we have to remember as investors what drives stock prices either higher or lower. And it's really important in that context to understand that the strength of this equity market, us being up 16% last year, up 9% this year, having some of the strongest quarters that we ever have had, oftentimes has to come down to how resilient and strong corporate earnings are. And what has been very resilient, in fact, more resilient than even anticipated for the S&P 500 this year, has been this number, which analysts have now projected for the market to experience earnings growth year over year of now 24%. Anytime you get a double-digit earnings type of growth year, it typically bodes well for the markets. But we have to actually go back a little ways for us to see a year where we weren't coming out of a recession, right? When we're in a recession, go back to 2020, for example, COVID, that first 6 months of 2020 were particularly tough on the market to an extent. They were very tough on the US economy, and earnings actually fell that year about 14%. So it's not surprising that in 2021, when the economy was turned back on again, people were out spending, businesses were spending money again, and people were out there and contributing to the economy. Earnings were up 49%. So when we look at a 24% earnings number for 2026, or what's anticipated, that is like screaming incredible optimism for U.S. Profitability and U.S. Earnings growth. So that has been the backbone of why this market has stayed as resilient as it has, because underneath the surface, despite all of the noise that has been out there, you do have earnings coming through at an incredibly strong clip. And it's worth noting up to the top right here, when we look at profitability of companies that we're investing in, we think about profit margins. You are talking about some of the highest profit margins in the world when it comes to specifically US equities. And if we were to unpack that even further and we were to look and break down some of the tech stocks or some of the AI related stocks that we're well aware of and are sort of household names at this point, some of the profit margins of those companies are not at 15%, but you're talking 25, 30, 40, 50% profit margins. When you pack it all together, you have an incredibly strong backdrop to what drives stock prices higher. And that has been a really big underlying reason for why stocks have stayed as resilient as they have amidst the noise.
Justin,
Now,
can I interrupt you real quick?
yes,
Is there a way
please go
you
ahead.
could make your it full screen just because these graphs are so
Oh, I'm
so much
sorry.
information? Or yeah, that's helpful. Perfect. Thank you.
Is that better? Can you see that better?
Yes.
Okay. Apologies on that. So let's unpack that just one step further, because when we look at the U.S. equity market uh, and we talk about the S&P 500, there's a number of sectors that make up that stock market, and there's obviously 500 stocks within that stock market. Now, what has been a big driver of optimism behind US stocks, what has been a big driver behind some of the return profile and some of the earnings picture has been the AI story. We think about tech, we think about how we're living our day-to-day lives now. It's very difficult to go through, at least my day among others, where you're not using artificial intelligence in some form or fashion. So some of the companies that you see here off to the right, again, household names, NVIDIA, Meta, Amazon, Alphabet, Microsoft, Apple, those are what's referred to as the Magnificent Seven. Uh, those have been a key contributor, or those types of stocks have been a key contributor to the return profile of the US stock market over the last few years in aggregate. Uh, if we look at 2026 so far, what has been interesting is whereas some of these stocks, those big tech names that you see here on this page, where some of those stocks really were the only sort of game in town for a couple of years. So far this year, those same stocks, all the way off to the far right, some of them are down on the year. Some of them are just keeping pace with the broad market, the S&P 500. It's really only in the case of Apple that is actually outperforming the S&P 500 year to date. So how can we then have a market that's up 9% when you've got some of the biggest stocks in the index, down or flat or maybe just up a little bit? And what you've seen this year, which we think is a very healthy attribute to the market as a whole, is a broadening out story. I mentioned there are a number of sectors in the S&P 500, and for the last few years, investors have really latched on to technology being the one sector that we had to own to make money. And everything else sort of like took a backseat to tech doing well. That has not been the story so far in 2026. In fact, if we look to the top left of this chart, um, you have the Mag 7, those seven stocks that you see off to the right. If we were to look at their cumulative return of the seven combined, they're up about 5% so far year to date. The rest of the market, the other 493, are up cumulatively 11%. So that 9% number that you have as a whole, broken down between your Mag 7 and everybody else, is actually more coming from the 493, which has not been the case for really each of the last 4 years. It was really a Mag 7 driven tech oriented AI story. Not so far this year. There are other sectors that are contributing, and a lot of it still has to do with AI. Or if we think about the build out of the data centers and the infrastructure that the big companies are spending money on to get the AI story really built out. Well, that's construction, that's material costs, that is industrial companies that are benefiting from that. And so other sectors that are not tech oriented are benefiting from a lot of the AI story, but it's really just taken until this point for that to really come to fruition. But it does speak, in our view, to a healthier market where it's not just a handful of companies driving the whole index higher. Now you're seeing a lot of other companies, a lot of other sectors contributing to what has been, once again, a strong story for US stocks this year. Now, if we were to break that down on a global basis, and we were to take a look at the rest of the world, you'll actually see that if we focus off onto the left-hand side of this chart, the U.S. was really the only game in town for the last 14 or 15 years. When we take a look at the annualized return of the United States versus all of these other regions, Japan and the Eurozone and emerging markets, thinking China, India, places like that. There was, again, it really speaks to the AI story that had developed, the tech story that had developed, that was largely and uniquely a U.S. story. And so for the last, 14 years, well, from about 2010 to 2024, the United States delivered an annualized return of 14% per year. It really lapped the other regions by a wide margin. And so investors as a whole took a significant leaning of their portfolio towards what was doing well, which was the United States. Now, last year, we started to see the tide turn a little bit. And you can see the returns last year, whilst the U.S. was not lagging by any stretch. The U.S. had a very strong year last year at up almost 18% when you include dividends. But you look at places like the Eurozone and emerging markets, and they finally kind of woke up. Their economy started to look a little bit stronger, and U.S. investors started to rotate assets finally away from some of the U.S. dominated sort of return profile that had existed for so long. And they just said, look, my portfolio maybe perhaps could do with looking a little bit more diversified. And I'm starting to like a little bit more what I see from some of these non-U.S. regions. And for what it's worth, that story by and large has continued so far here in 2026. Um, the US up about, again, with dividends, 10, 11%. Japan's up about 16. The Eurozone's up about 10. Emerging markets up about 20. And so we do expect this story to continue. Earnings have looked a lot stronger outside the United States. Finally, they're sort of matching some of the earnings growth potential that you're seeing here in the United States for the first time in a good long while. And again, it's giving investors some optimism and some reason to further diversify their portfolios. So this is certainly again, a healthier global economy that's emerging, which maybe didn't look as healthy broadly over the last 10 or 15 years. One chart that I love that's just, if there's one that you'd ever want to print out and just maybe put on your refrigerators to get a grasp in terms of which companies in the United States are the top 10 largest companies. And we actually break this down by decade. And it really gives you a sense in terms of just how much innovation and technology is changing every decade, or at this pace, every 5 years or so. And so if you look off to the left, we start back in 1985. These 10 companies that you see off to the left, those were actually the 10 largest companies in the S&P 500 that decade, right? You see names like Kodak and a lot of oil companies. IBM is in there, and sort of IBM stood the test of time for a little while. And you can see in 1995, the colors that change are when they were first introduced into being the 10 amongst the 10 largest companies. So the ones that in green have stayed from where they were in 1985. The ones in gray are new to that decade. You can see in '05 a handful of new names. In 2015, in the dark blue, a handful of new names. And then in 2025 and 2026, a whole handful of new names. And if you were to add up now, as of July of 26, the market capitalization, the worth of the top 10 companies now in the S&P 500, they add up to be almost $25 trillion. Those top 10 companies make up 38% of the S&P 500. One could argue that's a little concentrated or a lot concentrated, which what I mean by that is that more of these companies are taking a bigger slice of the pie than they ever had before, which could lean or preach to that diversification story I just made mention of. But what's a fun exercise is to look at these companies and guess amongst yourselves which of these companies won't be a top 10 company 5 years from now or 10 years from now, because you can see the innovation and the technology always changing. It's likely, in our view, 4 or 5 of them will stay where they're at because of how big they are or how they're just innovating the right way. But four or five of these big companies today are very likely not to be amongst the top 10, uh, 5 years from now or 10 years from now. And so it's the ever-changing leadership of the U.S. equity market that's taking shape as technology shifts, as innovation shifts. Now, we've talked a little bit about the U.S. equity market and what has driven us higher so far this year and that earnings backdrop. But if we were to also look at the U.S. economy, remember every year we're sort of being led to believe that this economy is due to fall into a recession. You saw that in obviously 2020. We were led to believe in 2022 when the market was down that we were going into recession, 2023, and so on and so forth, that this economy can't withstand what's being thrown at it. And the reality is that has just been a fallacy up to this point. And so we have to digest a little bit about what drives this economy higher. And there's really been two factors that we've seen that has led to the strength of this economy staying where it's at and in fact growing. One is the consumer balance sheet. If we look to the left-hand side of this chart, you can see what makes up the consumer balance sheet. If we were to add it all up, that consumer balance sheet stands at about 200, almost $205 trillion dollars. That's the value of our homes, our investments, everything that's sitting in the bank, in deposits, everything that we would consider an asset. At the beginning of this year, that balance sheet stood at $200 trillion dollars. So in the last 6 months, there's been almost about 5 trillion worth of additional net worth that has come onto the consumer balance sheet. Why that number is important is that that is the highest net worth number that this consumer balance sheet has ever seen. And this is clearly a product of asset values going up significantly over a period of time. Even from if we were having this conversation, 12 months ago, and we were to just think from that time to right now, there's likely been close to about 15 trillion of net worth that's been added from that time to right now, and about 5 trillion so far added so far this year. And so it's difficult, therefore, for an economy to go backwards. It's difficult for us to see a further sort of contraction in U.S. growth when this balance sheet stays steady and is further appreciating in value. And the reason that that is because two-thirds of how the U.S. economy grows is consumer spending. It's consumption. And so in aggregate, when you have a very strong number of those consumers that have assets, they're seeing those assets go up, and then they're spending that money broadly throughout the U.S. economy. That has been the case now for a number of years. Even in a year like 2022, when interest rates shot up, when inflation was high, when the market was down, the economy didn't fall into a recession that year. And that is because we have such a stable balance sheet as a whole that allows these consumers, again, in aggregate, to go out and spend money, go on vacations, um, uh, keep this economy afloat when it needs to when it needs to. And so, the headline risk around the U.S. economy can or the perception around the U.S. economy can flat out oftentimes be worse than the reality of how it actually looks. As long as these asset values stay afloat, as long as people have jobs, as long as the consumer can keep spending money, then it's unlikely, in our view, that this economy has the ability to really meaningfully fall back into any sort of recessionary type numbers. Of course, we are sensitive to the fact that this has been referred to as a bit of a K-shaped economy, or a lot of a K-shaped economy, meaning that if you think about the letter K, you've got one side of the K going up, you've got the other side of the K going down. The one side of the K that is going up are people in this economy that have assets. They invest, they own a home, uh, they have a well-paying job, and they've seen asset values go up, and they're spending that money because they have it and they can and they want to. The other side of the K, if you don't have assets, if you don't invest in stocks, of which there's a good portion of Americans that do not, then it's a different looking and feeling type of economy. It's an economy that you're feeling more squeezed by higher inflation or just higher prices, higher gas prices, among other things, higher food prices. It's a consumer or an American that is feeling more squeezed by higher interest rates because they have to finance maybe more of their spending that's taking place. And so we are sensitive to that, but we also have to be mindful that this number here is an aggregate number, and that aggregate number is going up, not down. And as a result of that, the consumer balance sheet, we think, is in a healthy place. The other aspect of the spending, which has been very resilient, has been the artificial intelligence spend. And this is a topic which is highly scrutinized for what it's worth. So if we were to break down off to the left here, just what's being spent by just these five companies up in the top left, just this year, the anticipated number is a little over $750 billion dollars. That's on AI infrastructure, um, a lot of the data center build outs that is taking place for the anticipated further growth of AI uh, is what you're seeing in these numbers. And the anticipated number by Wall Street in terms of what the spend could look like in the ensuing next couple of years continues to drift higher. So by 2028, or even maybe next year, you could see these five companies spending upwards of almost $1 trillion on AI build-outs, which pales in comparison to what you see. If you just go back 6 years, 7 years, you're seeing that the spend so far this year in 2026 is almost 10x, 10 times what we were doing just 7 years ago from these companies. So this AI theme, it's a big one. There's a lot of spending that's taking place to further support the AI build out and the AI infrastructure build outs. But the question that remains, and one that is continuing to be on the minds, and hence why it is a scrutinized topic, is all of this spending justified to an extent that there is a return on that investment that we're seeing? It's like if you're a farmer that's planting, an orchard, you're not going to see that fruits materialize for a few years. What you're seeing right now with a lot of this AI spend is these companies effectively doubling down on the spend for what they deem to be a significant ROI or return on investment in the coming years based upon both our usage of artificial intelligence and businesses embracing and spending a lot of money on AI for how they would use it in their practice or their business. When that comes is debatable. And you have some investors starting to be a little leery in the short term of saying, look, like, what have you done for me lately? If you're spending all of this money, then there is bound to be a bit of a revenue shortfall somewhere in your business that you may not be able to make up for that. And so we are at a little bit um, of a pivot point, if you will, in terms of investors seeing the optimism and thinking long term of what this means, sort of combating with short-term expectations and the reality of how things are shaping up at the moment. Again, it really speaks, in our view, to not piling all your eggs in one basket in the event that AI has some pause at some point in time before it sort of extends or further, moves along in the direction, we think it might. But in the short term, at least the economic impact has been significant, and it is helping in conjunction with the U.S. consumer to keep this economy in good, solid footing for the time being. Now, I do want to shift focus just for a moment on a couple of the risks that are outstanding that could materialize further. We've had to deal with them to an extent so far this year. And a lot of it revolves, at least presently, around geopolitical risk, and specifically around the geopolitical conflict and war with Iran. Now, why any sort of geopolitical conflict um, in the Middle East, oftentimes the question around the impact immediately comes down to, well, what does it do with oil prices, right? And we saw in the immediate aftermath of the conflict with Iran that oil prices jumped upwards of about $110 a barrel. Now, for comparison's sake, off to the top, the bottom right here, in December of last year, a barrel of oil was trading at $55 a barrel. As of just a couple of days ago, it was trading at $82 a barrel. As I mentioned, it did extend higher to, past $100 a barrel over the last few months. That's significant because we just talked about the U.S. consumer being the backbone of what drives our economy higher. The spending that we're doing, our willingness to spend, our ability to spend, that really matters. So when you see a a gallon of gas go from a national average of about $3 up to a national average of $4.50, and obviously maybe a lot higher here in Washington, of course, where we're sort of routinely shocked maybe by what we're putting in our gas, our cars, and the cost of that every single week. That matters because that's a lot more money that would be going elsewhere in the U.S. economy if it weren't going to oil and gas. And so the further that gas prices stay elevated, the more that it has the potential to take a bit of a piece out of U.S. GDP growth. Because, if I'm taking an extra 20 or $30 every week to fill up my gas tank or more potentially, that's 20 or $30 that I would be not then buying on a cup of coffee, going out to the movies, going out to dinner. I'm putting it in my gas tank. And I've been doing that now for the last, 4 months. And at some point in time, the longer that persists, the ability for that to take a bit of a piece out of the U.S. growth story, it could materialize. Now, as I just made mention of, we've got a cushion, if you will, with the U.S. consumer because of how strong that balance sheet looks. But if this were to persist, if that conflict with Iran were to get worse before it gets better, then at some point in time, you'd have to think that that would begin to weigh not only on the U.S. economy to an extent, but it would begin to weigh on markets as well. And when I say that it would begin to weigh on markets, the one additional risk that comes with higher oil prices is higher inflation. And higher inflation is just strictly higher prices, right? And it's something that we've almost had to get accustomed to, whether we like it or not, over the last few years, because of where inflation has gone. Now, you're looking at a chart here of inflation going back, about 7 or 8 years. And really prior to 2022, inflation was sort of a benign number that we didn't really have to pay a lot of attention to. Inflation was running about 2% per year. Uh, Nothing to really write home about, and nothing that would have caused the Federal Reserve any angst around raising or having to raise interest rates up until 2022. Now, 2022 might have been a perfect storm of easy monetary conditions, and there was the war which is ongoing to an extent with Russia and Ukraine, which really caused gas prices to go up. But there were a lot of different things in play in 2022. But as you can see, despite a very headline-worthy number and a 40-year high at that of 9.1% inflation in June of 22, that number went down fairly quickly with over the next 18 months or so, back to a effectively almost 2% in April of 2025. And it sort of stayed at that. But you can see here over the last few months that inflation is starting to tick up a little bit more, maybe much to the chagrin of the Federal Reserve, which is doing its best to keep inflation closer to about 2 to 2.5% if they had their way. A lot of the inflation impact over the last few months, which is the green bar, not surprisingly, is energy. And so if energy, again, were to stay more persistently higher, those oil prices were to go up more so than to go down, then there are ramifications across the broader U.S. economy in terms of higher prices. And it does put the Federal Reserve in a little bit of a jam in terms of their ability to be accommodative to the U.S. economy. One of the thoughts, which was not a thought at the beginning of this year, but it's certainly played into maybe how the Federal Reserve will be thinking at the back end of this year, is actually seeing interest rates go up, not down, in order to combat inflation and bring it back down to a level that they feel comfortable with. We're not at that juncture yet, but these are several of the risks that are out there that investors need to take into account over the next sort of 4 or 5 months, and hopefully the conflict in the Middle East resolves, in which case that would solve a lot of these problems, in and of itself. Now, as I wrap up here, I always like to end, on a chart around, and I've sort of mentioned diversification and asset allocation really being important and sort of pivotal to, how we allocate capital and how we invest and making sure that we keep our emotions in check. And so every single one of these boxes or colors represents a different asset class, a different place for us to invest in portfolios. The green box is large cap stocks. That's the S&P 500. Fixed income is in the blue, which is just bonds, part of a well-balanced portfolio. You see international in the dark, or sorry, in the gray. You see emerging markets in the light purple or lavender. All of these different asset classes represent a different place that we can have in our portfolios. What we've done is just that black line down the middle is just a 60% allocation to equities, the different equity asset classes that you see, and a 40% allocation to fixed income. And that's a well-balanced portfolio when we think about that 60-40 mix, or whatever, the risk tolerance may be. We look at that as something that's just more or less down the middle. It's never going to be performing at the very top, but we also know it's never going to be performing at the very bottom either. And I was telling Lindsey just on the front end, I'm a big soccer fan. I was fortunate to be able to go to a couple of different World Cup games. And I sort of heard this analogy the other day, and it's perfect to a chart like this, but you would never put a team together of just goalies, right? You wouldn't pick a team and say, well, we're going to have 12 goalies or 11 goalies out on the field, right? You'd have a goalie, and then you'd have defenders, and you'd have people playing offense, and you'd have a striker. And it's a perfect analogy to how we look and feel about investing and making sure that we're diversified and we have that good mix of asset allocation to take advantage of when we want to score a goal, but also to make it have that defense in play um, to avoid some of the dangers that we're seeing, whether it be a soccer game or some of the risks that we talked about on some of the previous pages. So with that, Lindsay, in the interest of time, those were some prepared comments and charts that I had, but I will stop my share screen here and just turn it back over to you.
Yeah, thank you, Justin. It's as you said when we were talking before, it's hard, I think, for clients sometimes because the headline news that comes at you, it feels like it's just constantly, less positive than than what maybe they're seeing in their performance or in their accounts. And so, how do we kind of line up what we're seeing as far as things that are happening, from a news cycle compared to what's happening in our accounts, and just kind of that disconnect that feels. So I love that chart at the end that just really kind of summarizes a lot of things that you said throughout the conversation of that we are seeing a lot of performance happening in places where we haven't seen it in the past couple of years. And that chart just really demonstrates some of those ups and downs and the analogy of how do we build out a portfolio, a team, or something where we're able to diversify risk by having different areas that are going to have different perform in different ways. And I think that's something that over the past couple of years, really, post pandemic, we haven't been hearing or seeing the benefits of diversification for a handful of years. And now we're kind of back to that traditional diversification, really providing for stronger performance, but also then just, managing risk. And I think that's one of the things that when everything's going up, feels like we want to participate in that. But to your comments of we don't want to build out a team that's just all one or the other. We really have, different pieces in there for specific reasons. So really want to thank you for your time. We haven't had any comments or questions pop up, so we'll give one more chance for a question to come in. But I think did a great job of just kind of covering those thoughts that people are having, and in our discussions, just what conversations I'm hearing coming up from clients as far as it's been a really positive market period. How is that going to continue? Where will those returns come from? And then just a good reminder of that graph that we started out with that shows some of those dips, peaks and valleys, I guess, in a given year and how much that happens over time. And but we still kind of see recovery and then can end positive even when we have some of those downturns that can happen intra-year.
Well, thanks for
Yeah.
having me, Lindsay. Always appreciate it.
Yeah, we really appreciate the partnership and your time today to share your thoughts with our clients. So thank you so much. Thank you everyone for joining. Hope that you have a great rest of your day, and we'll look forward to talking with all of you soon. Take care. Bye.